Hi, everyone. I was questioning, oh, hi, Lori, if the room would thin out, and it really did.
Yes.
But, you're not really going to miss anything, everyone leaving. So if you can, actually, you can stream it. So I'd like to introduce I should say myself first, I think. So my name is Omar Naeem. I'm the founder of LW3. LW3 Digital is part of LW3, and our mission there is very simple. We want to maximize the adoption of digital assets by the institutional allocator community. So basically, exactly what the last question was on the previous panel. Like, how do you actually accomplish that, right? It's not, our opinion is that it's not by going on CNBC, it's not by launching meme coins, and it's certainly not by running for president. I guess I'm referring more sort of to something that happened a few years ago. It's through education and creating a safe space for the allocator community to actually learn about the space, not be sold on the merits of it. God knows they're sold on everything else. Next to me is someone who is, I call him the Indiana Jones of the industry. One of the big challenges for allocators getting anything passed with their own advisory committees is that they're so far removed. And it's a really, one of these terms I use is, there's a Japanese word that's called kuchisabishi, which means lonely mouth. When you eat, because your mouth is lonely, so to speak, right? And I say, do you know what, how do you say in Japanese, I spend 99% of my time on 1% of my portfolio? It's called investing in crypto, right? And so very few people actually have done it so far, and the guy next to me has done it in a way that I haven't seen anybody else do it. But we can get into that in a second. Manoj, maybe go through your background a little bit.
Hey guys, Manoj Vasudevan. I'm with Kaust Investment Management Company. So for those of you who don't know, Kaust is King Abdullah University of Science and Technology. So we're the endowment fund or the investment arm of Kaust University. This is a university based in Saudi Arabia. Think of it as the legacy of the late King Abdullah. And fun fact, it's one of the 3 largest endowment funds in the world, university endowment funds. The university's probably has one of the largest university campuses on earth, about 8,000 acres of contiguous land. And we've been around for 15 years now. The team that runs the endowment is based in Washington, D.C., product of the early team being from the World Bank, and run like a typical university endowment, have a strategic asset allocation across publics, privates, hedge funds, real assets, and crypto is sort of a new technology segment for us. I shouldn't say it's new because we've been at it. Our journey into blockchain actually goes back to 2018. It was the year when we experimented in terms of having a small allocation in blockchain to learn about it. It wasn't as if we had a thesis around it. It was also the year when the first institutional crypto funds were launched. So it was a way for us to learn. And it actually sort of fast forwarding to 2021, it was that year when we actually came up with a robust thesis around the space, which we've been implementing quite actively over the past 18 months post FTX. So today, we're close to 1% of the endowment in terms of crypto exposure. And given how large the endowment is, it's pretty meaningful.
Has anybody here watched Doctor Who, remember? So we're gonna get into a bit of a time machine right now and go back to before Manoj and Kaust had any exposure to the asset class. So I won't provide any sound effects right now. So Manoj, most allocators dismiss and still often crypto outright. Yet you took the time to deeply understand the space. Was there a personal aha moment that you saw the blockchain potential and to put time into it?
So I think there were 2 aha moments personally. I think for the firm, the aha moment happened more recently, I would say, post FTX. But for me, this goes back to 2020. We'd already invested a little bit, sort of learned about the industry, and then come 2020, what really sort of stood out were the network effects around Bitcoin. And I think this is an underappreciated aspect of Bitcoin, as in, people understand Bitcoin for the most part. Most institutions understanding it's all about the scarcity. It's about the 21 million cap. It's about being store of value. But you know, even even if they had understood that, most people don't value store of values as institutions, right? Most institutions, and when I say institutions, I'm not talking about the family offices, I'm talking about my peers who happen to be endowments, foundations, pension funds. Most of them don't have a gold allocation. So why would they care about Bitcoin, right? But the network effects that I was seeing, especially in the year 2020, was around, these hedge funds that we had admired, for years, Paul Tudor Jones, and on the corporation side, Michael Saylor, One River Asset Management, in terms of the Bitcoin trade that had pulled off in November 2020, and they had a share. One of their biggest shareholders was Alan Howard of Brevin Howard. So we started to notice all of this in 2020, and Bitcoin is something you can't really value in terms of intrinsic value. And it's all about imputed value, which really takes you to network effects. And truly understanding network effects was what got us over the hump in terms of valuing that asset. So that was Bitcoin, right? So you got to sort of keep that aside. What really got me, what sort of gave me the aha moment on blockchain in general was something that Naval said, Naval Ravikant said in one of its podcasts about blockchain being a network of scarce resources, and it giving a system of orchestration between the demand side and the supply side through a token system, through a crypto asset. And that sort of really stood out to me, because you really can't pull off orchestration of demand and supply side through a traditional equity system, because value does not stream seamlessly, value does not transfer seamlessly, and you could now do that through a token or a crypto asset. And when I had applied that concept to Helium, which is what my phone runs on today.
Your phone runs on Helium.
Yeah.
How many people in the audience have Helium on their phone?
There you go.
Like one person.
For those of you who don't have Helium, I highly recommend you guys get on a Helium plan. It's about $30 per month, all in, unlimited data, unlimited talk time. There's even a freemium plan, so you could get a telecom connection for $0 per month.
Like he's pitching right now. This is
so
amazing.
It's a live use case. For
Yeah.
anybody who questions, what are the use cases of crypto? This is it, Helium.
I've used helium balloons, but that's a little different.
And by the way, it's a Harvard case study right now. So and I highly recommend people go and did about it. So, but that was a haha moment,
Yeah.
right? And I had seen that, and I sort of saw all of that happening in 2020.
So you were what he didn't mention in terms of the growth of the endowment and their digital asset exposure is that, which I found to be the most eye-opening, was that you were essentially running like a multi-year internal education campaign, quarterly or so emails to his entire IC about what was happening in crypto, including post FTX email, which I still remember that you wrote. What kept you motivated to do that when it wasn't your job? At least not directly, because you covered real estate at Kaus as well, and when there was no immediate sort of upside, I guess in some ways, maybe some downside.
So I think when I sort of had these aha moments personally, the first thing I did was, I think towards the end of 2020, I made my first presentation to the internal team, and it didn't fly. I had 30 minutes with them. None of it really hit the spot. And I was discussing with some of my peers who were also in the same spot as me, as to how they were also facing challenges in terms of getting the message across on how to really appreciate this asset class. And I think in 2021, there was this idea that maybe, no matter how many presentations I make internally, it's just not going to fly, and maybe I should try the writing method. So I wrote a bunch of internal memos, and they were more long essays on what I was learning. So it was real time, sort of translating my learning through podcasts, through reading, into a long memo of sorts and sending it to the entire team. And this would be about how we as allocators should think about Bitcoin as an asset, blockchain as an asset class. What's the market structure at this point in time in terms of how a life cycle of a blockchain company actually sort of plays out. And these were new concepts because we were dealing with an extremely unique financial instrument called a token, which people were not used to, right? So most people really didn't know where to bucket this in their systematic asset allocation. So it was a bunch of education and memo writing that sort of like did the job over a period of time. It was constantly sending out memos, and most of the time nobody read those memos. You could actually see that in the, like, if you've used Outlook and sent out a mass email to your team, you can actually see how many people open that email and what's the average reading time. And the
But
average reading
I have a team of 4. It's
so,
still at 0.
and the
So
average reading time was actually 30 seconds
wow.
in these long essays. And but what, like, but I had like 3 or 4 actual readers within the team.
Wow.
One of whom was my CIO, and sort of like, and that sort of like kept me going. So.
Well, like so people were dismissive, confused, intrigued. Did anyone ever pull you aside and saying, "Hey, listen"?
No, people were not dismissive, and typically you don't
Yeah.
find people writing internal memos like this on technologies, especially in a setting like an endowment or a foundation or a pension fund. So obviously they were intrigued why I was doing that, but it was my way to sort of slowly induce education without any expectations.
So if
Because I was sort of like, I was doing it selfishly myself because I was trying to refine my own thoughts and trying to like build my own thesis as I was writing those essays. But most, like, I would never, like, nobody was like, it wasn't as if people were dismissive. One, because, most of them weren't reading it. And I think people were like, amongst the words that you used, it was mostly intrigue.
yeah.
Amongst the team.
So like, I guess if you hadn't taken the time, written those emails, so to speak, do you think that they ever gotten to the point where they would have invested?
Definitely not. Impossible.
Yeah.
It's just, I was like a dog with a bone constantly nipping and constantly talking about blockchain to a point where everybody got tired because there were these constant memos. I was constantly talking about it. In fact, I sort of like, question in 2020, like, why are all these hedge funds buying Bitcoin, right? And obviously, ask most allocators at that point in time, they would say, oh, they're talking their book, right? That's why they're talking about buying Bitcoin. But it was more about the network effects at that point in time, and that's what gives Bitcoin its reflexivity, its convexity, and so I feel like, if you're not constantly educating your internal team, especially for in environments like an endowment or a foundation whose main job is not to like explore technologies, it's to actually underwrite managers across these 4 asset classes. You're never going to go deeper into blockchain as an asset class. So.
Yeah, it's really interesting it's almost like a structural sort of challenge for the institutional allocator community, is that very few of them have the resources to dedicate to, this asset class, certainly in a way that Manoj has done it.
But I have to say that, it's not as if people didn't allocate. There was this 2021 bull run. Every Tom, Dick, and Harry sort of allocated to venture funds in blockchain. But I think most of them are pencils down today. Like post FTX, most of them are pencils down. And I think if you sort of don't have a strong foundation within your team and then allocate to blockchain because it was hot, and it was hot in 2021, it's bound to happen that when there is a significant correction or an event like FTX, everybody goes pencils down. And that's pretty much what happened, and is what happened. It's still happening now.
So how do you feel in terms of your internal sort of situation? Do you feel validated? Do you walk around with a cape on, or do you feel it's still very early in innings in terms of whether or not this was in terms of also Cal's exposure to the asset class?
I wouldn't say
validated.
Validated.
Yeah,
it's we are far from sort of like achieving the goals of the industry and what the industry is setting out to do. Maybe that validation will happen when we all have our first iPhone moment. It's still not happened. Like, people say stable coins are sort of an iPhone moment, but a crypto product that really takes off and has 100 million users, right, overnight, like ChatGPT. That hasn't happened. Like, I think that's when, like, I think the industry will truly be validated.
Right.
But I don't think, even though, we have significantly grown our allocation and the team now believes that this is something real, I don't take it for granted, because a lot of allocators came onto the scene in 2021, right? And they're no longer there because of what happened with FTX, right? So there's constant education. Like, I am very cognizant of the fact that we might have something break later this year or in 2026, something like a Luna or something like an FTX, which sort of like, again, takes our industry back to a GFC type of a moment, and then everybody goes pencils down again. And my job is to constantly educate and keep the team abreast across all these developments, and so that, like, if something like that happens, we know why, and we sort of like truly embrace that bust and sort of like continue allocating. Like, it's very easy to sort of like take a step back especially when things go wrong.
So we have a few minutes. What's a crypto analogy that you wish that more people in traditional finance would understand? Sorry.
I think traditional finance, as a rule, doesn't like volatility, right? If you think about the classical endowment model, if you were to just like simply invest in the markets, you have sort of this S&P curve that's volatile over a period of time, and the whole point about the endowment model or like an institutional model is to sort of mute that volatility and still achieve equal or if not better returns than the S&P, right? So it's all about like having a smooth curve. And the thing about crypto is that it is one technology that is also a market, right? You don't have a technology that is also a market. And with any technology, you can't build anything substantial or important without, like I would say, exuberance, irrational exuberance. Like, you need this type of retail mania, this type of speculative mania, like investors like us to open up our pocketbooks, to really invest in the traditional rails, to invest in the backbone and the infrastructure that the industry needs. And the analogy that I will make here is, think about what happened in the late 90s during the dot-com bust. Like, overnight, $5 trillion of value vanished. A lot of people lost money. I think the drawdown in the NASDAQ was 78 to 80%. But even though a lot of the capital was lost, a lot of that capital that was invested in the 90s went to building the backbone of the internet that we know of today. It went to building Google. It went to building Amazon. And I think as an industry, as TradFi looks into blockchain, it's about really embracing those booms and busts, because no technology will ever be built and will ever succeed without booms and busts. And which is what TradFi gets scared about, right? Like, everybody sort of like went pencils down after FTX, but FTX was just a normal sort of like a blip in the traditional progression of a futuristic technology, right? And so as you sort of like think about these booms and busts, and they're pretty violent, especially in blockchain and crypto, you have to consider the fact that it's always about whether the technology is going 2 steps forwards and 1 step backward. And that's always been the case with blockchain. And if you see that, just, it's about embracing that technology then.
1 step forward, 2 steps back?
No, 2 steps forward, 1 step backward.
Okay. So that's like a country dance, I think, country music dance. Anyway, thanks, guys. Everyone give them some applause.